Okay, so episode 3 in our 5-part series of geopolitics on the Expat Money Chat. And episode 3 is the tariff domino. How Venezuela can raise prices worldwide. So in the next 5 to 7 minutes, I'm going to explain to you in plain English the domino effect or the domino chain and what it means for your cost of living, your investments, and also explain the part most people miss. And you don't need to buy Venezuelan oil for Venezuela to hit your wallet. That's just not the case. If tariffs get used as a secondary pressure tool, prices can rise through trade routes faster than most people expect. So in episode 1, we built the map. That was energy, trade, inflation, interest rates, stocks and bonds, FX, and your wallet. In episode 2, we plugged Venezuela into the energy link, oil supply, sanctions, licenses, and uncertainty. This episode is about the trade link and how that fits in. And it's important because trade actions can hit consumer prices even when oil isn't moving much. So you might be asking, what are secondary tariffs? And I'll explain that to you in plain English, yeah? And it can be a little bit confusing and cut out the jargon. A normal tariff is simple. We add a tax on imports from country X, yeah? So, America's importing from China, they add a tariff onto whatever's being imported from that country, i.e. China. A secondary tariff is more like if country X does a specific thing, like importing Venezuelan oil, we'll add a tariff on their exports to us. And you're probably hearing a lot about that in the news at the moment. I know there was a recent announcement. Think of it as trade pressure aimed at changing behaviour, not just raising revenue. So this is a political tool as well. And there's a real world example of this. Like the US issued an executive order just like a week ago or so. This was back in March 2025, titled Imposing Tariffs on Countries Importing Venezuelan Oil, authorising a 25% tariff on goods imported into the US from any country that imports Venezuelan oil, including through third parties. That's the mechanism people refer to as secondary tariffs, and we've also seen this with Iran and such as well. Here's the number one misunderstanding. Who pays a tariff, right? And that's probably the most important thing to understand. A tariff is collected at the border from the importer, yeah? The company bringing goods into the country. It's not magically paid by a foreign government. That's not how it works. What happens next depends on pricing power. So some costs get eaten by companies through lower margins. Some get passed to consumers through higher prices, like we've been seeing, the rise in cost of living. And often it's a mix. So tariffs tend to push prices higher, especially when companies can pass costs on. And, let's face it, that's pretty common, right? So here's the domino chain. And it's pretty much this whole video in 30 seconds. Tariffs announced, expanded. Importers' costs rise. Companies reprice goods. Inflation prints higher. Central banks stay tighter. Bonds and stocks reprice, and your wallet gets squeezed. And let me make this real. If a 25% tariff hits goods from a country that imports Venezuelan oil, the cost of everyday products can rise directly or indirectly, depending on the supply chains. That lifts inflation pressure. And when inflation pressure rises, central banks become less comfortable with cutting rates. Markets price higher for longer. That hits mortgage rates, corporate borrowing, and valuations in your portfolio. It's not doom. It's just the mechanics of how cost shocks travel. So what does this mean for investors? When tariffs or trade restrictions add inflationary pressure, you often see a few patterns. Bonds get hit first, as I've mentioned. If yields rise, bond prices fall, especially longer duration bond funds. So that's something to keep in mind, yeah? Rate sensitive stocks will wobble. When markets expect tighter financial conditions, high valuation or long duration equities can feel that. And the third would be sector winner losers diverge. And how do I best describe this? I mean, companies with heavy import costs and thin margins will get squeezed. Companies with strong pricing power will hold up better, and anything dependent on global shipping inputs can become more volatile. The key is, don't react to headlines, react to exposure. If you don't know where your portfolio is or the areas that it's sensitive to, these could be rates, inflation, FX, you're going to feel that markets are random. They are not. So ultimately, what does that mean for our personal finances? I'll break this down again into three so it's like easier to remember. Everyday costs, goods inflation can creep up without a big spike, oil spike. You know, that can happen. Borrowing costs, if higher for longer takes hold, refinancing and variable rate debt will become more painful. What I mean by variable is the rate you're paying. Yeah, it can vary. And also currency swings. Trade stress can change risk sentiment, and that can move currencies. For expats, FX moves can either cushion or amplify cost of living changes. So the practical move isn't panic buying gold or doing something extreme. It's getting your basics right. Buffer debt strategy and diversification, and knowing your real FX exposure. So if you want to follow this without, kind of paying attention or doom scrolling, there's three easy ways to do that. And that is, one, look at official tariff announcements. Don't just look at what's being said, emotionally or for whatever reason. Not opinions, policy moves and effective dates. Two would be bond yields. If yields are climbing steadily and markets are pricing tighter conditions, and your personal inflation basket, a few categories that you will get hit the most if that's happening is like rent, groceries, transport, flights. Track those instead of, looking at generic headlines. So that's it. That's the tariff domino. Like, trade pressure can turn into inflation pressure, which turns into rate pressure, which shows up in your portfolio and your cost of living. So as we go into the next episode, I'm going to focus more on Greenland and the situation there, and also help you navigate that. That's going to cover things like security risk, shipping routes, and the critical resource narrative, should I say. So, if you enjoyed this video, hit the like, hit the subscribe. Really appreciate you taking the time to watch. If you have any questions, you can drop us an email at info@expatmoneychat. Really appreciate you taking the time to watch this. Thank you.